Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to discuss several macroeconomics indicators and how we can use them to better navigate financial markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the Black Friday sale on Into the Cryptoverse Premium at intothecryptoverse.com, where you can get access to all of these charts that you will see me show, or at least the ones on my own website. So make sure you check that out. We have launched several different tiers that you can look at. We will continue to run that sale for a few more days. So in this video, we're going to go through several things, okay? So we're going to first talk about real GDP, or gross domestic product, the unemployment rate, headline and core inflation, expectations for both of those next month. We're then going to talk about the United States interest rate, expectations for the interest rate going forward, the Treasury yield curve and the inversion of it, Treasury yield curve spreads, and then we're going to look at when the S&P 500 normally bottoms with respect to recessions. We're then going to take a close look at the current state of the S&P 500, the NASDAQ, and the Dow Jones, and then we're going to try to combine everything together to try to understand how it all fits together. Hopefully that makes sense. We're going to try to take it one step at a time. I know these are not necessarily the most popular videos, but I choose to believe there are dozens of people that care about this stuff. So we'll try to go through this. And again, forgive me, I am sick right now, so you probably will hear me cough throughout this video. But I'm going to do my best. So, U.S. real GDP is one of these things that a lot of people have pointed to in early 2022 as the reason that the United States was in a recession. And to be fair, there is at least evidence for that to be the case. If you look at the quarterly change here, which shows you when you have two consecutive quarters of negative GDP, like we did in Q1 and Q2, there has not been a recession declared for that time, despite the fact that normally when you see two consecutive quarters of negative GDP, it corresponds or it coincides with a recession. And the reason why that's important is because the S&P 500 normally sees a macro bottom during the recession. However, according to this, we haven't gone into a recession yet. Well, why is that? Well, you could argue that it's just political, right? And that might be the easy way out. But you could also argue that there were still a lot of metrics to suggest that the United States economy has remained relatively strong in 2022. Now, as investors, we might not always feel that way, especially if your portfolio is down significantly. However, we also had a bear market in other years, right, where they did not always correspond to a recession. It's just that recessionary bear markets tend to last a lot longer than bear markets that do not include a recession. So, real GDP has actually put in new highs over the last two quarters. So, if you were to argue that two consecutive quarters of negative GDP in early 2022 put us into a recession, you can't even use that argument anymore because we've been putting in new all-time highs. We took out sort of that brief pullback that we had, and we've actually accelerated back up to new all-time highs. Now, if we look at another metric, so again, this two consecutive quarters of negative GDP typically corresponds to a recession, which is this gray shaded region. Not this time. The reason, I think, and as made clear before, is that the unemployment rate still remains relatively low, right? So despite the fact that real GDP was down in Q1 and Q2, the unemployment rate has remained relatively low, and therefore the labor market has remained extremely tight. This is not generally a good thing if you're trying to slow the economy down, which is what the Fed's trying to do. Why are they trying to slow the economy down? Because they want to bring inflation back. They want to bring inflation back down to earth so that it doesn't continue to hurt everyday people who can no longer afford certain things just because they've continued to go up in price. And you might have noticed that with your grocery bill, things of that nature. But if you look at this, it's not historically until the unemployment rate actually starts to go up that we find ourselves in a declared recession. It's just that normally, when you see two consecutive quarters of negative GDP, you also tend to see the unemployment rate go up. It just simply has not gone up yet, right? It just simply has not gone up. And this is likely an artifact of some of the major world events that have happened over the last couple of years, but it just simply has not really budged yet. Now, we could argue the relevance of this data and the validity of it all we want, but at the end of the day, the unemployment rate has still remained relatively low throughout 2022. Now, we are starting to see layoffs coming, especially in the tech sector. I think that makes the most amount of sense since these were the companies that really shot off over the last couple of years. We also know that the NASDAQ has been performing pretty weak relative to some other major indices. And again, that's just made up of tech stocks. But we have real GDP putting in new highs. We still have the unemployment rate really low. But inflation is still relatively high. Headline inflation is now at about 7.7% year over year. Core inflation is at about 6.3% year over year. You can see that when inflation goes up, we tend to find ourselves at some point in a recession. Why is that? Why do all of these high inflationary periods tend to correspond to recessions? Is it just because inflation is high? No, right? That's not necessarily what just pushes us into a recession. It's the response by the Federal Reserve, right? It's the response by the Federal Reserve that ultimately does it. Now, we should understand what our expectations for inflation going into next month. Going into next month. And you can see this website is forecasting 6.2% for next month. Their prior forecasts have sort of been hit or miss. I mean, you're not going to get it exactly. But if it ends up still staying above, if core inflation stays above 6%, the Fed is still going to want to tighten, right? They might not go the full 75 basis points, but they still reserve the right to do that. Headline inflation could still be coming in at 7 to 8%, which is still not a good thing. I mean, it's going in the right direction at least so far, but it still is not down to where the Fed wants it to be. Now, I've heard a lot of people say that the Fed will change their target rate to 3 to 4%. And I've heard this throughout all of 2022. Just like I've also heard that they'll never raise the federal funds rate above 3.5%. Look, the Federal Reserve, Powell has been fairly clear as to what his mission has been, and that is to get inflation back down to 2%, no matter what it takes. Okay, no matter what it takes. He has often cited Volcker many times in order to, during his fight against inflation. And not only does he cite Volcker, but I also think he doesn't want to make some of the same mistakes that were made in previous, under previous chairs. And that would be to loosen monetary conditions too quickly. Okay? What would happen if they were to do that? Well, if they were to do that, you could get a period like the 70s and 80s where inflation comes back down, but then it just goes straight back up, right? You might see it come back down, but then it just starts to accelerate again because monetary conditions were loosened before they should have been loosened. And that is why you'll often hear Powell say things like higher for longer, right? Like, we will eventually go to these higher interest rates, but once we get there, they're likely not going to bring the interest rates back down as quickly as a lot of people want them to. And the reason for that is because they know that if they do that, like they did in cycles past, it could just lead to inflation coming right back. Now, you might want them to pivot and go to QE quickly. However, history shows us that if they do that sort of stuff and pivot too quickly, then you could see a stock market that goes sideways for 10 to 15 years, okay, during an inflationary decade. I would prefer for them to just rip the Band-Aid off. And so we don't actually have to deal with that. I would prefer for us to just get it over with and and get this fight against inflation back under control. So again, it's not inflation that by itself pushes us into a recession. It's the Federal Reserve's response. And you can see that is partially raising interest rates. It's also rolling off assets from their balance sheet, right? Going through a period of quantitative tightening, QT. But when they raise interest rates, this is going to naturally make companies who were very dependent on cheap cash, they're going to go under, right? These are zombie companies. And, I mean, it's not good for the people that are in those companies. It's not good for the people that get laid off. But in the grand scheme of things, it does help to cleanse the space of unneeded companies that are not actually profitable, and therefore focus the money back onto the companies that are actually doing something more useful, right? So I think that's something important to consider when looking when considering the effects of higher rates. So the federal funds rate is already at 4%, right? It's already at 4%. They're likely going to continue going higher. And if you look at expectations for the December meeting, we're currently looking at a 75-76% chance of a 50 basis point rate hike and about a 24% chance of a 75 basis point rate hike. So far, markets are expecting it to only be 50 basis points, which would still get us to 4.5% by the end of the year. My general expectation, as I've said I've said for the entire year, I think that they'll get to at least that 4 to 5% range. I now think they will get at least to 5%, and maybe they'll pause somewhere between the 5 to 5.5% range, but that doesn't necessarily mean they're going to have to cut from that level. I mean, if inflation doesn't come back down, they still reserve the right to eventually go higher. Now, why is this so important, and how does it relate back to recessions? Well, remember, when the Federal Reserve raises interest rates, it does offer new types of investments for people that may have otherwise not considered them. Fixed income, so things like, certificates of deposit, these types of things that you may not have considered for the last decade because you were only going to get like 0.25% or something as a return. Now you can get 4 to 5%. And while 4 to 5% might not be much for a lot of people, especially if they're used to chasing higher gains, it has proven to be a better option this year, stacking cash and just putting in some of these, CDs. That's actually proven to be a fairly attractive way to go this year, as opposed to writing down risk assets 20, 30, 50, 80, 90%. So again, it's just one alternative, and it can be a useful part of a portfolio. Now, when the Federal Reserve raises interest rates, that affects the yield curve. Okay? The yield curve shows you what type of yield you can get, annualized, of course, at various treasuries, like at various, lengths, right? So if you were to hold it for 1 month, you're looking at 4.1%, 4.16%. This is annualized though, so you would get like, 1/12 of that. But you can see that the 1 year is actually offering the highest rate. Now, this doesn't really make a whole lot of sense during normal times. During normal times, you would expect to see something like this, like in 2016, where the longer you have your money locked up, the higher yield you should get, right? This makes sense. But before you go into a recession like this, like the 2000, like the recession that occurred in 08, 09, you will see the inversion of the yield curve. And that's where you can actually get a higher rate for shorter duration yields, or for shorter duration treasuries. You can actually get a higher rate. Now, we're seeing that right now as well. You can get a higher rate for these shorter term treasuries than longer term treasuries. And one of the reasons for that is because in the short term, the Fed funds rate is still 4%, right? It's still 4%. And markets are still thinking they're going to raise by 50 basis points. Furthermore, in February, the market thinks it'll be up another 50 basis points to 5% by February. So even though there could be a recession coming, and even though the Fed might eventually have to lower interest rates, doesn't mean you can't get 4 to 5% in the short term. 1 month, 2 months, 3 months, 6 months, and a year. It only starts to go back down as you get further out, because banks are not as sure that the Fed funds rate is going to remain this elevated for a very long period of time, right? And as we get further and further out, you're not going to see these same types of high yields when there's so much uncertainty, when it feels like the Fed is trying to push us into a recession to get inflation back down. It feels like that's what they're going to try to, that's what they're trying to do. But if they push this too far, they're likely going to have to lower interest rates. Okay? And therefore, in the short term, you can still get higher yield because the markets are thinking that the Fed is going to keep raising rates. But over the longer period treasuries, you're not going to see those same rates. It doesn't mean you can't still get a decent return, but just not going to be as high. So please consider that. And again, before recessions, even the dot-com crash, you saw the inversion of the yield curve. We're seeing it again today. Now, if we take a closer look at the inversion, like the spread between the 2-year and the 10-year, or the 3-month and the 10-year, it looks something like this. And what you'll notice is anytime it inverts, so anytime the 3-month gives you a better yield than the 10-month, or the 10-year, anytime the 3-month gives you a better yield than the 10-year, for a long period of time, it's a good indicator of a recession. Exhibit A is where we currently are. I expect us to go into a recession at some point in 2023. But you can see it. You can see in 2019, we had a recession in 2020. It inverted here in 06, 07. We had a recession in 2008. It inverted over here in 2000. We had a recession in 2001, and so on and so forth. Right, 89, we had a recession in 1990. It's inverted in 2022. Decent chance we're going to have a recession in 2023. Now, there's always a chance it gets delayed. I mean, it just depends on how resilient the U.S. economy is. I mean, if it stays inverted a long time before making its move back up to the upside, then it could delay things. You'll notice that it's not until after it uninverts that you actually are sort of knocking on the door of the recession. So we're likely not going to see the recession occur when it's still down here. It's just a matter of how long is it going to take for it to start to come back up. Sometimes it could take a few months. Other times it could take a year, right? It's really hard to know exactly how long it will take. But one thing is obvious by this chart is that when you see these types of inversions, it leads to recessions, right? Now there is a period in 1998 where we had a brief inversion of it, but it was really brief, right? And it didn't lead into anything. This one's not brief, right? I mean, we've continued to just sort of go down, and and we're more inverted now than we have been since really since 2000, right? Like since the during the dot-com crash. Okay. Same thing when you look at the spread on the 2-year and the 10-year. A very similar story, right? When it inverts, we typically come out of it into a recession. Inverts into a recession. Invert into a recession. Invert into a recession. Why is this important? Why does it matter so much if we go into a recession? Right? Why does it matter? Well, remember, the recession is likely not going to be declared until the unemployment rate goes up. But once that starts to happen, the stock market tends to unwind, right? It tends to start to come back down. If you go look at the stock market, you can see it historically bottoms during recessions, right? Exhibit A, Exhibit B, C, Exhibit D, and so on and so forth. In fact, in only one instance did the major bottom occur after a recession, and that was during the dot-com crash. Now, remember, we had a pretty big event occur in 2001, so I think that sustained uncertainty led to an eventual lower low. But for the most part, the stock market bottoms during the recession, not before it, not after it, except for this one in 2002. It typically bottoms during the recession. But the recession doesn't start until the unemployment rate goes up. The unemployment rate isn't going to go up until the Federal Reserve gets monetary conditions to a point where a lot of these companies have to continue to lay people off, right? Now, you might think that sounds, cruel for the Federal Reserve to do, but they're doing it to combat inflation. They're not doing it because they want people to lose their jobs per se. Their mandates, of course, they want to keep inflation low, and they obviously want to keep the unemployment levels low. They don't want the unemployment levels to go up too high. It's just it's just that they recognize that wage wage inflation is a real threat to overall inflation. And if they don't bring inflation back down quickly, then you could get to an inflationary decade where we just don't make a lot of progress. And I think that's what Powell's trying to avoid. I think you'd rather get inflation back down so that we can go back into hopefully a long period of economic expansion rather than just play in the sandbox for 10 or 15 years. So, what about today? What does the S&P 500 look like today? Well, it's just been putting in a series of lower highs. Okay? And these macro charts that we've been talking about in 2022 have been what has continued to allow me to focus mostly on stacking cash. Now, it would be a lie to say I haven't bought anything, right? I have occasionally picked up some things this year, but I'm not picking up super risky things this year. I'm picking up, very safe options. And the safest, of course, is just to stack cash. So that has been my primary priority in 2022. Once I really realized that this was going to unfold, was that I just thought, all right, well, it makes sense to stack cash until these macro headwinds have sort of gone away. Okay. Now, so far, the S&P has just been putting in a series of lower highs and lower lows. And every time we get one of these crazy rallies, everyone starts getting really excited again and talking about how we're, going to go put up, we're going to see some crazy melt up, right? There hasn't really gone a few months this year where someone's not talking about a melt up, to new highs and whatnot. But so far, that has not yet happened. And every single time we have one of these rallies, everyone calls for a melt up, and it's just another lower high, right? I mean, to me, a lower high is just not a melt up. It's just a counter trend rally, right? It's a bear market rally. It's shorts covering, retail FOMOing back in after the shorts cover, and then people looking at these resistance levels and then saying, all right, well, it's probably going to go back down, and then eventually it does. And this just happened many, many times this year. So this looks like a structural bear market, right? It looks like a structural bear market through and through. We can look at this and say, you know what? It looks pretty close to an average bear market. You might say, right? You might say it looks pretty close to an average bear market. You look at the 2022 bear market and you compare it to historical ones. We're pretty average right now, pretty average bear market. Still a good chance we could go higher in the short term, especially if we see a sustained rally, getting into December, which is somewhat seasonal. But there are going to be a lot of macro headwinds coming into play still, and that is the Federal Reserve raising interest rates because inflation is high and still waiting to see that unemployment level finally start to go up. When it does, we likely get that recession. That's usually where the stock market bottoms. The NASDAQ is also putting in a series of lower highs and lower lows. Okay? It's the same thing. And this rally for the NASDAQ has actually been relatively weak compared to some of the major indices. This is a structural bear market as well, right? Look, bear markets don't resolve themselves overnight. And recessionary bear markets can take like a year and a half or something on average, like 16 months or, they take, on average, they take a longer period of time than bear markets that are not part of a recession. So we have to consider that. The biggest, counterpoint, I suppose, is the Dow Jones, right? Let's put in a new high. So lower high, lower high, lower high, higher high, right? It's a higher high. A low, a lower low, a lower low, a lower low, a lower low, and a lower low. Now, this index is putting in a higher high here. What does that mean, right? What does that mean for this whole theory? Does that mean it's not valid anymore? Well, I think what we should do is take a journey back through time. Now, remember, during 2000, if we go back and look at the S&P back in during this bear market, it was a fairly structural bear market, right? A lower highs all the way down Here it was still technically, I believe, a lower high, and so on and so forth. Lower lows and lower highs. Fairly structural bear market. Now, the Dow Jones looks different in 2000. Okay? And we need to consider that. Look at this. This is the Dow Jones. I mean, look what's going on here. It's all over the place, right? It doesn't show the same exact type of trend that you would have expected, like the S&P did, right? Where the S&P was essentially always putting in, lower lows and lower highs. The Dow Jones can see rallies that basically take it back up to around the prior high. That's not that uncommon for the Dow Jones to do that. It still put in lower lows, even though the highs were sometimes very similar. And in fact, if we were to take a bar pattern and maybe, grab it from right here and then shift this over, and we're going to take this all the way over to the current time. So all the way back up. Oh, sorry. We're going to bring it all the way up here. We're going to just make some comparisons, right? So we'll zoom out. And maybe, maybe I should put this on like a weekly time frame so it's not so confusing. That might be a little bit better. Let me just do that really quick. So I'm going to switch this over to a weekly time frame just to just to clean up some of the data so it's not so convoluted. Let me switch this to a log scale as well. So again, the Dow Jones right here. So we're going to take this bar pattern, right? This one, put it over here. Now, what do you notice, right? I mean, you can look at this and see, right here, this was a pretty crazy rally back up to the upside. Right on the weekly, it went higher if you don't include the wicks. It's a pretty good match, right? It's a pretty good match for some of these rallies. The Dow Jones can see crazy rallies even during a structural bear market for the S&P and the NASDAQ. It doesn't mean it can't go put in a new low eventually. If it were to follow this one, it might mean putting in it still maybe still has some juice in it. But as you get into mid-December, late December, and then in 2023, you could still be looking at a new low on the on the Dow in March or February or March of 2023, followed by maybe a bounce back up in the summer, and then maybe even another low later on. But this is something that is important to consider, is that just because the Dow Jones has put in a new high doesn't necessarily mean anything. The Dow Jones historically has acted somewhat similarly, while the S&P and the NASDAQ tend to just behave in a more structural manner where they put in lower highs and lower lows. So again, to sort of summarize here, we have recessions in gray, we have inflation in orange. This is headline. We have core inflation here in yellow or green. We have the effective interest rate in yellow, and then we have the S&P 500 in purple. One of the things you may notice is that, and let me clean this up just a little bit. One of the things you may notice is that interest rates in general tend to have to go above inflation before inflation comes back down. The yellow line is the interest rate, and then the other two lines are headline and core inflation. But normally you'll see interest rates go above inflation before inflation comes back down to earth. Right now, we're not even close yet, right? We're like 4%, but core inflation is over 6%, and headline inflation is over 7%. So it shows you that the Federal Reserve still has their job to do ahead of them to get inflation back down under control. This is why I often say in 2022, I say cash is king and don't fight the Fed. The Fed will continue raising interest rates despite the fact that the economy is slowing down because they need to get inflation back down. They want, I believe, and I think they've said this, right? They want unemployment to go back up a little bit, the unemployment rate, so that it loosens the job market some to help reduce some of those inflationary pressures. If they can accomplish this, then the interest rates need to get closer to where inflation actually is. Okay? That's why I think they're going to make it to at least 5%, at least 5. They need to get closer to 5% and maybe even 6%, right? They need to get at least 5% to get inflation back down. During this process, it will likely lead to more layoffs. Eventually, we will likely see the unemployment rate go up. When the unemployment rate goes up, we finally get a likely recession, right? We're likely going to see a recession. Remember, when the recession hits, or right before it, the yield curve should uninvert, right? The inversion will be gone. You'll see these go back to normal. Once it uninverts, we likely get a recession. When we get the recession, remember what happens when we get the recession? That's normally when the stock market, normally when the stock market bottoms, right? S&P 500 bottoms usually during the recession. So you can kind of see how it all works together. Now, again, my interpretation of this stuff is it could be ignorant, it could be naive. I'm just showing you what my interpretation is based on the data. And what I see, just to summarize one more time to just make it as crystal clear as possible, right? Inflation's high. Real GDP is putting in new highs. So according to that, we're not in a recession. The Fed will continue to raise rates. They'll continue to roll off assets from their balance sheet. This is likely going to make it so that that monetary conditions tighten. People will be laid off. We'll see the uninversion of the yield curve. We'll go into a recession. That's likely where the S&P 500 bottoms. That's my general assessment. Okay. Where could this be wrong? Well, I suppose that if the U.S. economy is stronger than people think it is, then perhaps the Federal Reserve could raise to 5% and the U.S. economy continue humming along. And it doesn't necessarily have to experience this. But that's not my base case. I mean, I still would argue that we're very much in a structural bear market, and and we still have a lot of macro headwinds to face as we get into 2023. I also think we're going to start to see some earnings coming in for a lot of these companies in 2023, less than expected. And maybe you'll even see negative GDP again, or 2 consecutive quarters sometime in 2023. But maybe by that time, the unemployment rate will actually go up, and then you'll see that recession declared. And at some point during that recession, which is usually declared after this recession starts, then you'll see the S&P 500 bottom, and so on and so forth. I know this has been a lot. I hope I've done at least an okay job of explaining this. And I mean, we've done several videos on this before. I wanted to provide an update because it had been a while, and we know that we have some pretty important stuff coming up soon with new inflation data coming in, in December, and we also have another FOMC meeting by the Federal Reserve in December as well, where they will likely raise interest rates again by at least 50 basis points, with a 24 to 25% chance of a 75 basis point rate hike. So we'll see what happens. We'll continue to follow the Macroverse, because I do think it helps us navigate financial markets. Remember, if you guys like the content, to subscribe to the channel. We also do have the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We're going to run that for a few more days, so make sure you check it out. We do have several different tiers that you can sign up for, which should provide options to different people. So thank you guys for tuning in. Subscribe. I'll see you next time. Bye.